If you thought Friday's sell-off was nasty, just wait until the real capitulation begins. I'm talking about down 3% or more in a single session, not over the span of the entire week. Most sectors are already broken in stage 4 downtrends, and we're really just waiting on one final shoe to drop, and that of course is semiconductors. After NVIDIA's fall from grace on Friday, we could be pretty darn close. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off today with a closer look at the SPY monthly timescale, and yes, we do technically still have 2 more days to go before the bar is officially closed, but we're working on a solid red-bodied bar with an extremely heavy close towards the low end of the monthly range, and of course this is a breakdown from a multi-month balance range that we had overhead. I think it's worth pointing out that we have more than doubled the range in the downward direction, which of course classifies this as a successful breakdown. I don't think anybody's arguing on the contrary. As it relates to the bar-to-bar count, clearly a lower high and a big time lower low. The biggest thing we care about on the monthly timescale is the monthly higher low thesis, which as we know really ties in with this previous set of highs here. We know that the monthly 20 SMA is just a hair above that area, and really the zone between about 615 to 610 is the monthly higher low. Remember that we have lows, higher lows, April tariff higher lows happening here, and of course the opportunity for a higher low maintaining the monthly trend in the upward direction, noting that we are officially pulling back from the highest high in the trend count. Recall that the monthly chart has been very respectful recently, using previous resistance as newfound support. We'll see if the same thing can happen this go around. Again, 615 to about 610 is the magic spot right around in here. It's also great confluence with a Fibonacci if we pull from the April lows up to the most recent all-time high. Fibonacci 38.2 is right on the money at that level. This is also your general monthly reminder to just say something like, hey, if the monthly trend does flip to down, if we break and set a lower high underneath the monthly 20 SMA, I would be more concerned about a protracted bear market in the current circumstance, but right now we're not really threatening that, right? This is the dot-com bubble bursting. If we scroll forward here and of course remind ourselves of 2008, the great financial crisis, here's the lower high, the monthly trend is down, really bad things happen in the market. If we go on over to the current look of the monthly timescale, what might start to trigger this, and this could be multiple months away, would be if we do rebound off of this level, come up, set an equal high, aka a monthly double top, and then look like this in the future. Yeah, we'll talk about a much more protracted bear market. Oh my goodness, buckle up, this is going to get nasty. It doesn't even have to be an equal high. You could get some sort of a lower high as well, just to draw that in as a hypothetical. Maybe you do something that looks like this, you set a lower high, and then you're like that into the monthly 50, or heck, even worse, back down towards the April tariff lows. I mean, we're not discounting that as a future possibility, but please, for the sake of keeping a level head, let's take it one step at a time. As of right now, the primary thesis on the monthly is to figure out what happens here at roughly 615 to 610 for all the reasons we've described so far. We're in a monthly uptrend. We have the 20 SMA underneath us. It's the Fib 38.2, and the structure makes a lot of sense. Let's take this down to a weekly timescale and see what's going on from this perspective. Of course, we'll start with candle structure and location as we always do. Let's zoom in a little bit further. There we go, and take a look. In terms of candle structure, solid red-bodied bar, back-to-back solid red-bodied bars. Obviously, if you've been trading this market actively, you've felt this intra-week. It's gotten much more intense in the downward direction, of course, so the bears are in control structurally. If we think about location on the bar-to-bar count, clearly a lower high as well as a lower low, and another candle close completely outside of and underneath the previous week's range. It goes without saying, of course, we've also broken down underneath the 50 SMA. As we look left, we also know that we extended last week underneath this prior set of double bottom lows here from, of course, October of 2025 and November of 2025. This was the China reignition, if you will, of tariffs, and this was the NVIDIA earnings sequence. So the fact that we're substantially below that now means what? Of course, as we're counting trend, any counter trend movement can now set a clean weekly lower high beneath that level, and that is roughly around 653. We'll get more granular on the daily chart in just a moment. There's no arguing that if the market tries to make a turn, if it tries to make a move in the upward direction, we have a lot of basically overhead power lines, as I like to call them, that could potentially bat down price for a lower high. So the 2 big ones that I would still be concerned about on the weekly timescale, once again, roughly 653, right around in here. We'll talk with more detail on that in just a second. And still way back up here at roughly 675. Let's not forget that you could go all the way back there and still be setting a weekly lower high, right? You could get some sort of look below and fail. We rally this week, we go through this, everybody starts to jump for joy, and oh my God, look, everything's fine, right? You reject here for a weekly lower high, you're still in a downtrend, things get nasty, and we're still targeting that 610, 615 zone to the downside, right? So your weekly trend is clearly down. Let's go ahead and grab a fib from the top end, the all-time high down to the local low. What do you know? I mean, just for all intents and purposes, a lower high underneath the structure is a lower high underneath the fib 38.2. And if we do set a lower high here up against that 675 area, it would be rough confluence with the 61.8. Once again, just pointing out that if the market rallies, it seems to me that it is a counter trend rally in the context of now a firm weekly downtrend, undeniably producing a lower low. If you were skeptical about saying from here to here we had lower lows, I mean, maybe I could let that slide a little bit, but undeniably now this is a lower low and we are officially in a weekly downtrend. As we zoom out on this chart, we already pulled the fib on the monthly from here to here, but I'll just remind you one more time, there is that confluence level that we're looking at, 615. Really, if I look at these prior highs before the fake break to the all-time high prior to the April tariff debacle, the level is more like 610, right? So 610 to 615, treat it as a little bit of a zone. I mean, if we're looking for a monthly high or low, we can handle a 5-point zone, right? Let's come in here with the Fibonacci's, or sorry, not the fibs, but rather the anchored VWAPs on the weekly time scale. Just pointing out that we're underneath the entirety of the stack here, and we're actually resting on the anchored VWAP from this prior all-time high, the fake breakout that I was just pointing out here in the early stages of 2025. So if that gets lost, there's literally no other Fibonacci, that's twice, no other anchored VWAP reference point underneath us other than this one, which you might be saying, okay, what's that all about? Well, let's zoom out further on this chart and grab something like, let's go 10 years. We generally want to see the 2022 low. You'll notice that we had support here, right? This is the rounding bottom of the 2022 bear market. This, of course, is the monthly higher low thesis Brigade bolt over the inverted head and shoulders. There was perfect confluence there off of that anchored VWAP. The April tariff low did not quite get all the way into it. I'm just saying if we overshoot this area here, I mean, again, please don't get me wrong. I'm not saying that this upcoming week in the next 4 trading days, because Friday the markets are closed, right? Good Friday. I'm not saying we're going to look like this. I'm just saying that's probably the next major reference point to use as it relates to an anchored VWAP stack. All right, let's bring this back down to a monthly, or not a monthly, excuse me, but rather a 3-year time scale there. And let's throw on our volume profile just to check in and see what's going on from this perspective. And as we know, we've been talking about this for weeks now. This overhead supply is heavy. It's the point of control. It's the highest volume node on the chart. As we look left, let me actually zoom back out a little on that. This is all a low volume void until we come into the monthly higher low thesis, right? That is here, once again, 610. I'll bring out the measuring stick because why not? You're looking for really about another 4% in the downward direction. And as mentioned in the intro, that could easily happen if we're truly going to experience like gut-wrenching capitulation, a gap down on Monday, follow through to the downside. That could be well within the cards for early on in the week. And when and if we were to approach 610, I would start looking for a counter trend snapback off of this prior high. Now, does that mean that this is the end-all be-all low of the move? No, as we just described, there is room still for a weekly lower high. So what would I want to see to become really constructive about, okay, here comes the turn, let's start to trust it? Well, number one is you have to actually set some sort of a low, right? So ideally it's somewhere in here. Then we start to rally. As we pull back, the next key in the sequence is that you must, no ifs, ands, or buts about it, if this is going to be a constructive low, you need to find a higher low. Right? You cannot afford to go back down to the equal low. If we find some kind of a higher low, then fantastic. I'll start to trust this a little bit further, especially when and if we could bring in a weekly higher high. I want to give you this sort of sequencing, before it happens. That way you can watch it in real time in case it doesn't align perfectly with a weekend update or a midweek market update or a pre-market prep, whatever. So that's what you need to see. You need to see a weekly higher low paired with a higher high before things actually start to say, okay, this is firm. Right? So that would be the big sequence reversal in the upward direction. If this lower high comes back down to an equal low, then what are we expecting? In the context of a downtrend, highs, lower highs, lows, equal lows. I mean, not to insult anyone's intelligence, but what's the next thing in the sequence? A lower low, right? Downtrends are lower highs, lower lows, and equal lows. So something that looks like this, you get a lower low and you're still talking about a nasty downtrend on the higher time frame. So those are the big areas that I'm paying attention to. Let's take it on down to the daily chart. Let's get a little bit more granular. And of course, we'll begin by evaluating this week's expected move. If you're not familiar with the expected move, first of all, it's this gray shaded area right here. You can check out the video tutorial in the top right hand corner on how to set this one up. The upper bound of the expected move is here at 653, roughly, what is that, 31, give or take, call it 653.50, confluence with that weekly area of support that we were literally just talking about off to our left. So once again, if this market tries to rally early on in the week, not only do you have possibility for gap fill reversal, and we'll talk about that in more detail in a second, but you could just be setting at the upper bound of the expected move a lower high. And that's a lower high as it relates to the weekly chart. It's a lower high as it relates to the daily chart. So that, of course, is bearish. If we're looking at the lower bound of the expected move, it's at 614.87. And that's, of course, just straight up continuation in the downward direction. So no matter how you slice it here, we're dealing with a bearish expected move. We're certainly in a bearish downtrend. I think that speaks for itself. Anyone who's still in denial about that and saying, oh, no, the market's just going sideways still, like, all right, wake up. It's been about 2-3 weeks now where we've confidently been in a downtrend. So we're sitting on the lowest low. Let's talk a little bit more about trend, right? We're sitting on the lowest low of the daily downtrend. Notice that this did not hold as a double bottom. We went gap and go underneath that level into the end of the week on Friday. So it is very possible that coming from a lower low, any sort of counter trend rally will be thought of as exactly that, counter trend. And we're really just looking at service to a lower high. As we mentioned, gap fill reversal would be a great spot for a potential lower high. Think about it exactly as a fractal of this, right? You have prior lows, 1, 2, and 3. Once we break below, resistance, resistance, resistance. Now, it's 1, 2, 3, 1, 2, 3. It doesn't have to be 1, 2, and then, 1, 2, and then go. That's not what I'm trying to get at. But the point is that previous support can certainly now act as resistance, which would be a perfect gap fill reversal anyway, the ideal place for a lower high. As mentioned earlier, if we were to reclaim that gap close and do something that looks like this, a rejection right up against that 653 is a rejection of the prior weekly lows. That would be a beautiful spot risk reward wise to look for a lower high, place some shorts, and look to target something like that to start. And of course, ballooning runners down into the equal low here at 634. If we do just get gap and go to the downside where the capitulation really starts to get heavy, you'll know it because it's going to feel a little bit queasy in the morning session on Monday. If we gap down and continue in the downward direction, boy, oh boy, that's going to be fairly nasty. I would start looking for a counter trend off of these areas, and the same thing would apply, right? You can go counter trend here. You can look for a long if you've got the stomach for it, for risk reward along these lines right here. But when and if we start closing this gap, I would promptly be thinking about, all right, this is the next best spot for a lower high. Let's see if we can set up shorts and take the exact opposite risk reward trade, right? If we go a little bit further than that, once again, something along these lines, risk reward for a gap fill reversal back to the downside would be the next primary outcome. So the name of the game here is to seek lower highs now that we have ultimately set a new lower low in the trend count. Let's go ahead and take it on down to the hourly time scale and see what's going on from this perspective. As we can see, and what we really do on the hourly chart, right, is try to put ourselves in the shoes of the opposite side of the trade. If you were more bullish this market, you were really paying very close attention early on in the week, primarily Monday, Tuesday, Wednesday, for the possibility of inverted head and shoulders, right? Something that looked like this, trying to hold a higher low as it relates to Friday's low of now 2 weeks ago, just like what we had back here. Left head, right shoulder. Ideally, you wanted to see at least an attempted breakout, but did that even happen on the Wednesday session? Survey says absolutely not. And this is where we can even start to bring in a little bit of the headline talk, right? So what has this market been driven on as recently? Of course, as noted on Wednesday, it's all about the war headlines, right? And on Monday morning at 7 a.m., there was the tweet and the post that, hey, we're in negotiations and we're going to put a 5-day ceasefire out there. Great. The market rallied and it certainly made a high. Let's now use this as the major reference point as it relates to the MFEU scale, right? If you don't know what the MFEU scale is, maximum fear, complacency in the middle, and euphoria over here on the right. This is a step in this direction on the MFEU scale. Things are getting better. We're trying to de-escalate. We're trying to, it was what, the 15-point plan for peace or something like that. So progress in the right direction. and we set a euphoric high in here. Now, remember that there was additional comments throughout the week that said, yes, negotiations are going well. We're making progress. Iran gave us a plan back and we're considering that. We're trying to do this. So you would think that the news flow was actually moving in this direction. But what did the market do? It was unable on Tuesday and it was unable on Wednesday to actually take out that Monday high. So it's less about the war and the new, news headlines as of right now, and it's more about the fact that market conditions are just straight up weak, right? And this was the major thesis of the Wednesday midweek market update video. If you missed that one, I'm just sort of rehashing it here. The market doesn't really care about the war headlines anymore. It cares about the fact that every single sector is really starting to get into an aggressive stage 4 downtrend, right? It cares about the fact that there is zero rotation going on right now. It cares about the fact that there is zero risk appetite out there right now. It's less about the war. It's like the oil shock was the big catalyst that pushed the market over the edge. Now it's past the point, right? So that's what's happening here. Of course, on Friday, there was also another announcement of like, hey, things are, or what was it, Thursday after the close, Thursday after the close, like, hey, things are going well. The market hardly rallied. Let me just throw on the extended hours for just a second. We'll take a look at this, right? So this is pre-market Monday. Oh my God, things are getting better. This is Thursday. Hey, we're going to extend the ceasefire for an additional 5 days, right? So you get an additional 5 days here. And where is the market relative to that Monday high? Once again, the point of the exercise is to illustrate, the market does not care about anymore the news headlines and the war. The market totally cares about the weakness that is just underlying the general market landscape, right? The risk appetite is not there. Nobody, or I should say institutionals, are selling the market, definitely not going out there and trying to buy it with both hands yet. So that's my take here. Once again, the fact that the inverted head and shoulders could not take out the Monday high just tells me everything I need to know about the market being weak here and the underlying conditions meaning more than the actual news itself. Here we go. Big downdraft into the end of the week. Of course, everything that we've already talked about, bearish, and we know if we do this, great, I am looking for this, awesome, and then follow through here, right? If we do something that looks like this, awesome, fine, thin structure retracement, weekly lower high, daily lower high, still at the upper bound of the weekly expected move. If we start to do something that looks like this, I would not be bullish here. I would be thinking about the possibility of a double top. If we go through, I'll use a dotted line. This is where I would start to change my tone a little bit more. Note that we would still be well underneath the daily 200 SMA if that were to take shape, okay? So I would think lower odds of this situation here. If we get the gap down, I don't know that I'm chasing this into the lows unless there's a very obvious setup intraday, 5-minute opening range break to the downside, lower high sub VWAP or something like that. When we get here, I would start looking for the counter trend to come up and close this gap, in which case I intentionally have drawn this, right? So you have left, head-ish, right shoulder, beautiful lower high, trend remains in the downward direction. Notice that this is not quite reaching into that 610 level yet. 610 is the monthly higher low thesis that we were talking about on literally the monthly time frame. It's just a hair extended through the lower bound of the weekly expected move. If we're truly in a nasty capitulatory market, we will overshoot, no problem, the lower bound of the expected move, right? This is just a suggestion from the options market. And, another point here is just that last week, this was how much risk was priced in. I would not call last week capitulation. We did not even extend into, never mind through, the lower bound of the expected move, right? What else did I want to say here on the hourly? I wanted to talk more about volume, excuse me. So we'll go back to the daily, then we'll go with the anchored VWAPs intraday. Volume for capitulation, please take the time and just kind of study what happened back over here. I'm going to go out to you always know it's getting nasty when you have to open up a daily on like a 3-year time scale so you could see prior examples or downside levels, but please study the capitulation of this area. Look at what happened with volume, right? We're not getting that same volume ramp. You want to be seeing like 300%, 350, 400% of the average 20-day volume if you're truly coming into a capitulatory low. And you also want, right, this big aggressive gap and go style mentality. The analogy that we've been using in the live stream in the mornings, that we've been using with the group, is that it wants to feel like you've been punched in the stomach once and you're like, okay, I can kind of take that. And then, not to be overly gruesome, so ears, but you get stabbed in the stomach. You're like, oh, okay, whoa, this is like something different. And then capitulation, this final leg here, that's when they start twisting the knife a little bit. And you're like, okay, geez, I tap out, I'm done, right? Enough's enough, right? It needs to be met with that feeling, extreme volume, and we're just not there yet. I know maybe a very visceral sort of description there, but like this could be the early stages of it. But once again, we don't want down, 3% over the span of a week. If I just grab Monday's open to here, you can see we're down about 3.6% or give or take. You want down 3% in a day. All right, so that's what capitulation will feel like when and if it happens. And as mentioned on the weekly chart, if we come into, let's just say we start to do this, we get a weekly high or low, and then some sort of a weekly high or high. If this can also be paired with supporting evidence, which is really the back half of today's video, if supporting evidence also starts to make a turn and look more promising, more improvements rather than continued degradation, that's where we become more trusting of it acting as an actual low. So hopefully this was an informative walkthrough on the S&P 500 about what we're ultimately looking for here if there's going to be a bottom. And once again, like, let me also throw into the mix that, like, this is the correct technical level. I'm looking for this to happen here. If it doesn't happen here, I'm also not going to fight that. If the market blows right through this and the next thing you know, we're sub 600, great. I mean, first of all, the downtrend's really getting aggressive, and we'll look for it at a lower price point. But for the upcoming week, this is at least the zone where I'll be watching for these types of things to happen. All right, let's drop in our intraday anchored VWAPs and see what's going on from this perspective. This is the Monday ceasefire peace deal, if you will. That's why it's white dotted rather than white dashed, just so we can sort of delineate a little bit. Notice great lower high confluence here, great lower high confluence here. Really not much to say other than, once again, if the market rallies without capitulating first, looking for lower highs and looking for lower highs. I mean, we've beaten that sort of thesis into the ground already. If we do gap and get extended, right, looking for a little bit of mean reversion, gap fill reversal, and then, you know, same thing here, gap fill reversal, lower high. As we've been talking about in the pre-market preps, cascading lower highs is the name of the game. Markets will not move in a straight line until you're at the very bottom of the move. All right, that's that. Let's jump on over to the market internals. If you're not familiar with the internals dashboard, check out the video tutorial in the top right-hand corner. What do we see here? I mean, generally, yeah, we're getting close. Look at the volume outflows on Friday. Look at the advanced decline line reaching into trend lower zone. Look at how bearish the build on the index score is throughout the back half of the session, Thursday, Friday. Look at the cumulative builds as well. That was a substantial build on both Friday and Thursday, both of them reaching underneath negative 5,000. So, once again, if you're sitting here in denial of the market being firmly in control of the bears, I don't know what more evidence you're looking for. You really needed to change your tone about 3 weeks ago at this point, which, hopefully we've been doing a good job of actively showing you the data points to make you aware of what's actually happening. As we look to the ES futures on the market profile, if you're not familiar with profile, check out the video tutorial in the top right-hand corner. What do we actually see here? I mean, we're consistently moving value in the downward direction. Here's Monday, Tuesday, Wednesday, right? Thursday, forget about it. Point of control completely underneath. Value is almost breakaway. The reason I say almost is because it's not technically underneath Tuesday's low. It's breakaway from prior value, but it's not quite breakaway from Tuesday's low. Nonetheless, big shift in the downward direction, and Friday value is certainly lower than the Thursday session, obviously with the gap there. But also one thing to point out is we do have a small string of single prints into the afternoon. And if you recall from back here, oops, let's clear that up. Back here, J period singles, that acted as temporary support on Tuesday. I'm curious to see if we get the same thing. I mean, not that markets always have to be, perfect rhymes of history, but there's your H period singles. If we were to get some kind of an open above that level, let's say there's positive news over the weekend, the market's like, okay, we'll do something silly in the after hours, Sunday night headed into Monday. If we open above, support above, I think that would be a very, I don't want to use the word obvious short, but it would be a great technical short. If you open above single prints and then fail back below them later on in the week, it's basically a rinse and repeat playbook of what we experienced this week, right? So I would carry that forward as the main takeaway from the market profile. Great excess in M period, A period, no poor high, poor low to repair from that perspective. Let's jump back on over to the platform here and let's take a look over at the NASDAQ side and see what's going on with the Qs. Let's bump this thing up to a monthly time scale. Again, we still got 2 days to go until these bars ultimately close out, but for the time being, I mean, we could at least take a look at where we're at relative to the reference points. So similar concepts as the S&P 500, solid red body bar, big upper wick. I shouldn't say big, actually. It's just kind of like, it's a meaningful wick relative to the prior size of the wicks, but the candle body dwarfs it. No doubt about that. If we were to continue lower, we know that the level here is about 540 as the monthly high or low thesis on the NASDAQ side of things, well within spitting distance. We could easily get there in the coming weeks worth of trade. So watching that area, it is all for all the same reasons as the S&P 500, the level of interest, so we won't rehash them all. We'll come in with the fib just to illustrate that this is still fairly accurate here, right at the zone. It's a little bit north of it as of right now. It's better confluence with the monthly 20 SMA. Nonetheless, that area, that zone, once again, let's not split hairs. We are in a monthly uptrend with lows, higher lows, potential for higher lows here, pulling back from the highest high in the trend count. Let's go ahead and take it on down to a weekly time scale. And let's get a little bit more granular here. We know that we are still accelerating underneath these major lows. The one thing that we did point out last week was that you did not quite have as bad of a breakdown on the weekly bar. That's sort of like kiss that thesis goodbye. There's no longer really any relative strength here on the NASDAQ from that point of view. Weekly structure goes to the bears, solid red body bar, lower high paired with a lower low, candle close completely outside of it and underneath prior week's range, taking the 50 SMA. Just no good here on the weekly time scale if you are a bull. If you're a bear, great, rock and roll. You're looking for that 540 previous highs. And in here, there's a little bit of support, which maybe we're coming into. We'll see those levels on the daily chart in just a moment. But for the most part, again, the monthly magnet really is 540. If we jump in with the anchored VWAPs, I'm not going to say Fibonacci's like I did on the S&P, you'll notice we're under the entirety of the stack, and we're even failing this prior all-time high anchored VWAP, which on the S&P, we closed just a touch above it. I think if I go ahead and grab the SPY set, I just want to be able to look at that same 2022 anchored VWAP. I don't think I adjusted it on the Q set. So notice that first of all, the April debacle didn't quite make it all the way to it, and it would be much, much lower than the S&P 500. That would be a confident break if we come in from here up to here. Yeah, that's well underneath the Fib 61.8. That would be a very nasty retracement. Not to say that it can't happen, but let's once again take it one step at a time, bar by bar. Let's deal with the next 4 trading days on the weekly time scale. I think here 540 is the place to watch. I do just want to point out, let me clear up those studies for just a second and go back to this. We didn't really talk about the lower high potential, right? We're obviously in a weekly downtrend. We're sitting on the lowest low. If the market rallies back, lower high potential galore, right? You've got that. You've got the 20 SMA. You could probably strike a trend line in here as well and say something along those lines would be worth a watch. I'm not a big fan of trend lines. I much prefer the horizontals. And for me, that's right around in here, roughly around 593. All right, let's get on granular, or let's get on down. We'll go to the daily chart, but let's be congruent. That's on me. Let's go to the weekly volume profile first. Let's zoom out. This is that 5-year chart. Let's go back to a 3 and let's just take a look at this. High volume node confluence with the lower high zone. That's the main illustration, and your high volume node starts to realign with the monthly higher low thesis. So no real change in that. Let's jump on into the daily now. Let's talk about the expected move and beyond. So taking a look at this, there we are. There's the expected move. We've already talked about the video tutorial. So the upper bound is right around 580.75, and the lower bound is down here at 544.80. Once again, very clean illustration of either just a nice lower high or continuation for a lower low. The trend is clearly down on the daily time scale. That really goes without saying. But there you have it. Your lower highs, obviously lows, lower lows, and big lower lows on Friday. All the same concepts as the S&P 500, so I won't belabor the point. If we rally and do something like this, let's say a red to green move on Monday, lower high here, right? Boom. We go further than that, great, lower high here. And honestly, weekly lower highs there really make a lot of sense. I would think about this and the primary outcome being something along these lines. If this starts to step back up, is, think about this from the reversal perspective we just talked about on the S&P. If this marks your major low, and I'm talking about this dotted path now here, if this marks a higher low and there's a daily reclaim of 595, IWCMT, I will change my tone, but for now, I would say that that has lower odds of shaping up, and I would think that the lower high thesis that we've already outlined is the main name of the game. If we do open on that gap down into the capitulation territory, you do have a little bit more of that weekly support that we were just looking at down here. It's about 552.75 down to about 546, the lower bound of the expected move. So I would be thinking, okay, you could go here, you could bounce, close this gap, and then continue a little bit lower and bounce. And, if we start to get one of these, right, what did I just draw? Classic inverted head and shoulders, right? Maybe that offers a stronger weekly counter trend. I don't, unless we actually get capitulation, I would not latch on to this as being the end all be all low. As a good illustration, what we did last week was we looked back at 2022. Just as a reminder, bear market rallies are vicious. Let's go to a 5-year chart. I always forget that, believe it or not, 2022 is that far away, huh? Bear market rallies are vicious, right? Just when you think there's a double bottom and you break the neckline and you're here, you get a weekly lower high. At that point, you're obviously well below the 200 SMA. Another leg, right? Just when you think, again, a little bit of a double bottom over the neckline, maybe this consolidation breaks higher, new low. Oh, look, we're finally getting higher lows here. You've broken this. That's a higher low. Everything's great. new lows, right? So bear market rallies are vicious. They tend to suck people back in. And once again, without true capitulation, if we do get sort of that inverted head and shoulders that I was just drawing, if this is just a gentle bottoming formation without volume capitulation, I wouldn't be much of a believer that, oh my God, we're going to be here in the next couple of months just off of a simple daily, inverted head and shoulders. Capitulation or nothing, right? That's kind of it. Bear market rally or otherwise. So let's jump into the hourly chart. I'm realizing we didn't throw fibs on the S&P. That's fine. It's not going to tell us too much more, but same thing here. Underneath the 61.8 makes decent sense. Previous lows now act as a lower high resistance point, right? Upper edge of the weekly expected move. If we're contained here, it's gap fill reversal at the 38.2. Let's just go back to the spiders. Sorry to jump around a little bit, but let's just do this. In terms of looking for confluence, same idea. Gap fill reversal and or that big 653 level on the weekly time scale. Just wanted to double check and make sure there wasn't something like, glaring that was going to throw the entire analysis off. Not that I think there would be. I think the charts are pretty straightforward to the downside at this point. Now that we've finally found trend, right? The only reason I could say something like the charts are fairly straightforward now is because we have found a trend. Back here, this is like not straightforward. This, a little bit more straightforward, right? So with that being said, on the hourly chart, all the same comments as before. Let's not redraw the pathing. Let's just look at the intraday anchored view apps and we'll keep things moving here. You can see confluence at the upper bound with the Monday anchored view app and then Thursday right at the gap close area. All the same comments as the S&P 500 in terms of levels. Let's drop it at, pathing off of the same relative level. Let's jump on over into the NASDAQ side of the market internals. See what we got going on over here. Huge volume outflows, weakness, big advanced decline line extension under trend lower zone, big cumulative builds in the downward direction. Clearly bears are stepping up at the exchange level. The one thing I will make note of here is that you are a little over correlated, so to speak, quote unquote, over correlated into that Friday session. So if there is going to be a counter trend, I would not be shocked if it comes on the heels of a move like this. Just to show you this in another, let's go market watch in another sort of visual. What am I trying to do here? I want to go from visualize. There we go. Heat map. We want index watch. And then let's just throw in here, of course, our NASDAQ 100. There it is down towards the bottom. There you go. So declining 85, advancing 15. That's pretty heavily correlated in the downward direction. Typically capitulation, you might have something like a 95-5 split there. So that's worth paying attention to. If you just want to check the capitulation slash issue on the S&P 500, where am I going? I want S&P 500. There we go. S&P 500. There it is. So declining, not really as bad, right? 388 versus advancing 110. You probably want that ratio to be like 450 declining and 50 advancing, if not worse, to start looking more like capitulation, right? So just a hallmark sign of volatility when it's, sell everything one day and then buy everything the next day, or, in this case, the opposite, buy everything one day, sell it all the next day. Hallmark of volatility. And that's hallmark of what? Volatility happens more so in downtrends, bear markets. Let's jump on over into our NQ market profile, see what's going on from this perspective. We'll probably see lots of the same as to what we just covered in the S&P. You could see value here on Thursday, it really wasn't as bad of a breakaway to the downside as the S&P, but Friday really just speaks for itself. You don't really have the same amount of single prints in H period, but you do have that designation. So I would say the same concept applies. If, let's say, there's some good news over the weekend, we open above, consolidate, kind of fail, I would say a late week trade would just be a break back into or underneath the single prints from Friday to initiate a new short. If we just open and stay in the lower distribution from Friday onward, that just tells you everything you need to know. Anybody who tried to buy this on the gap down from Friday stuck underwater there with or acting really as overhead supply. That's what we've got on the NQ. Let's take a look over at the Rusty Russell. Let's see what's going on in small cap land. Let's do the same thing. We'll bump it up to a monthly chart. We'll go ahead and grab, let's take a look at the 20 and 50 and 200 SMAs. There we go. Perfect. So in terms of monthly structure, solid red-bodied bar, right? And again, 2 days to go until it officially closes out. Solid red-bodied bar, a little bit of an upper wick, a little bit of a lower wick, for the most part, coming back down towards this area here and this area in here. We are still in a monthly uptrend with lows slightly higher low here from April. This was more impressive as a higher low in that lower wick. I would say this area should, if we're going to remain in the most constructive and ideal uptrend, should remain above this as a consolidation range, right? This is a multi-year consolidation. If this breakout is going to actually be successful, you really don't want to see prices much lower than, what is this, roughly 236 give or take. Underneath 236, we have another failed breakout, right? This is a failed breakout here. And we're just, I mean, this was so irritating to talk about. Do you remember how sideways we were for like 2 years in the Russell down here? 1 month up, 1 month down, couple months up, couple months down. So like, we don't want to get back into that territory. And honestly, if this is a look above and fail, yikes, you could be talking about this in some sort of future situation. Let's not jump the gun on that. That's like a back pocket, really, really dire situation. As of right now, if this is going to be, let's try that one more time. If this is going to be a great breakout for small caps, if this is going to be risk on for the market, if this is going to speak to breadth expansion, then you need to hold this area. Now, what does this all hinge upon? It's probably the next steps out of the Fed, right? And the Fed right now is stuck between a rock and a really hard place with what's going on with labor as well as inflation. The oil shock, of course, is not making their job any easier. So the fact that the rate curve and the projections forward, instead of really, reducing like that, are more so just flatlining now, that's a pretty brutal look for small caps. And, I would not necessarily latch on to this idea that you need to see a technical bounce here unless there's some sort of a shift in Fed policy that says like, oh, look, we actually found this data point, or, we're looking through the oil shock, or things get better, or for some reason, crude prices can come down more substantially. We're just spitballing here. Main point on the monthly chart is, yes, this is a very important area of support. I'm not necessarily convinced that it needs to hold. If we had more mild conditions in the broader macro sense, not that I'm trying to be big old macro guy here, but if we had better macro conditions, then maybe. But right now, it's just like I've got very little trust that this is going to hold for a clean higher low here. Now, it doesn't totally negate the monthly trend, right? If you overshoot the level, you could overshoot that a little bit, have an arbitrary higher low in here in hindsight, and then start to work higher. But boy, oh boy, is that going to be a little bit of a complicating issue to then reclaim this area around, once again, just call it between about 236 to 240. Let's drop this thing down to, we'll take out a fib before we go. April low up to the recent high. 38.2, kind of right in the neighborhood of what we were just talking about. Just give it a 10-point zone, 230 to 240. If we could hold that, then great. If not, kind of pretty tough look there. Let's now take this thing down to a weekly chart. Let's get into the more usual analysis. This, of course, weekly structure does not look good. Look at the upper wick rejecting the weekly 20 SMA. Look above and fail on the previous week's high. There was some really strong, or I should say great, relative strength early in the week from the Russell, and that just completely faded into the close of the week. Now, we did not make a bar-to-bar lower low, so there is still some degree of relative strength here, but I would not, again, start pounding the table for, oh my God, everything looks great in small caps. It would really need to prove it by holding over a neckline of the inverted head and shoulders, which we'll talk about on the daily in just a second. Speaking of head and shoulders, I mean, this is the total, failed breakout look we were just describing on the monthly. If we get some sort of a rejection here for a larger weekly trend, complete like failure, right? So I'd say we are already in a weekly downtrend via lower lows happening here, and potentially, you could use this upper wick there as a lower high. I'm not really constructive on small caps in the short term, even though the daily chart looks kind of okay. This is a tough chart for me to really get behind. And if you watched last weekend's video, I sort of tried to express that the best I could by saying like, this chart's a little funky, right? Let's jump on into the weekly anchored view apps in the middle of the stack rather than being under the entirety of the stack. Once again, a little bit of relative strength from that perspective. Let's come in here with the volume profile. There it is. And let's just zoom out a little bit. Where are we relative to the high volume node? I mean, this is the high volume node as it relates to 1, 2, and 3. We're sort of underneath that as of the close. I wouldn't really say that we're into the low volume void yet. And if we were, right, that 230 and 240 zone is kind of this low volume void that we rotate through. And that determines the fate of the monthly, whether it looks like this or whether it looks like this. So pretty critical over the next couple of weeks, I would think, for small caps as it navigates this next 10-point zone. Let's take it on into the daily chart for smalls, and we could start to look at, of course, inverted head and shoulders was happening there. You blew out the right shoulder on the Friday session. But firstly, let's stick to the usuals. Expected move here, the upper bound 252.24, the lower bound 233.96. You can see that that kind of puts us in maybe neutral territory at the top end, but certainly bearish territory at the bottom end, blowing out to a new lower low. We are still over the 200 SMA. You got to give a little bit of credit where credit is due. Once again, like I hope you can maybe hear a little bit of the tension in my voice as it relates to small caps. I'm not jazzed up about them, but I'm also not as bearish small caps as I am on, S&P NASDAQ, looking for that big capitulatory style low. If this just holds in there as a double bottom and we're here, I'm not going to be all that shocked, right? And I'll say, okay, it's holding its own. And then if we could reclaim the 20 and do something that looks like that, all right. Now all of a sudden we're looking at a stronger monthly higher low thesis, and very possible that if the Fed starts to turn their talk around, maybe we're drifting back up to highs here. TBD. Again, this is like a back pocket situation. I don't want to get overly fired up on the long side because as of right now, Friday put the pressure on, broke the right shoulder. To me, it's just like any consolidation underneath 245.50. I'm going to be equally as non-shocked if we break the 200, travel to the equal low, if not further. Right. And this does start to unwind and the market's like, no. Small caps. I don't know why you've thought you've had this relative strength. You're no different. Right. And just, unwind it here. Now, the real reason that this is taking place. Right. Think about XLE. Not to say that XLE has direct overlap with IWM, but small cap companies, there's a lot of energy companies, small cap energy companies, US based in the Russell 2000. Right, that's one of the major reasons why this is not completely falling off of a cliff and going to zero. So that's, if you want the logic behind it, that's kind of why. But for now, not really, again, jazzed up about this going to new all-time highs. It's kind of like either side of 245.50 would be reasonable to me here, and it would sort of give us a confirming data point or not for the S&P and the NASDAQ. Let's drop it on down to the hourly chart here. You can just kind of see once again the relative strength on Wednesday, my apologies. Wednesday gapping up and over these prior highs just to give it all back on Thursday, Friday, and not also respect the right shoulder. So I would tend to think if these people were buyers, right, now they're trapped overhead supply. Anybody who is just sort of getting involved and churning through here, now they're trapped overhead supply. The longer we stay underneath 245.50, in my view, the more bearish it becomes, looking for this to play catch up to things like the S&P and the NASDAQ by taking out the 200 SMA. If we drop in the intraday anchored view apps, just to take a peek at where we're at from this perspective, underneath the entirety of the stack, very similar to the others. The only thing that's saving grace here is the daily 200 SMA below us. Let's take a look at the Russell side of the market internals. What do we see here? Substantial volume outflows on Friday, big advanced decline line shift, and cumulative builds definitely drifting in the bear territory on Thursday and Friday. Nothing that I don't think anyone wouldn't have expected. Let's jump on over to the market profile and take a look at this. What do we have over here? Zooming out a little bit. There we go. Value is moving in the downward direction. Here's Monday, Tuesday. Notice that Wednesday's value was clean to the upside. And once again, sort of seems to me that that's now trapped overhead supply with Thursday and then certainly with Friday value closing week with point of control low of day basically on smalls. So, overhead supply definitely trapped. And once again, the more time we spend underneath that 245, was it 50 or 75? Level on the IWM 245.50. The more time we spend underneath that, just all of this is now trapped overhead supply. I would think this is heavy, a little bit more of a bearish edge than a bullish one. So that's the IWM take. Let's get on into our S&P sectors. Let's take a look under the hood and see what is actually going on here as it relates to the components. XLE up 8% on the week. I mean, once again, very obvious what's going on here. If you haven't been watching crude very closely, then, you're living under a rock right now. Energy up big time. XLB sort of doing okay, up 3.19%. What's the trouble there? It's the lightest weight sector, literally the lightest weight sector in the S&P 500. It's not going to mean diddly squat. How about that for a word or a term? It's not going to mean anything for the S&P 500. The XLU, defensive and also a very lightweight sector. XLP, defensive, closing flat on the week, literally 0%, a donut hole there. All right, let's take a look at the bottom of the barrel. IGV software, not directly an S&P sector, but I mean, sure, you've got Microsoft in there, down 8.3%. Carnage. Go take a look at the Mag 7 ETF, down 6.38%. Carnage. Google, Meta, Microsoft, they're all exploding, right? Look at the XLK, down 5.5%. XLC down 5.17%. SMH, although it's still hanging on by a thread, and we'll get to that structural chart in a moment, down 4.86%. I mean, this is downright ugly, right? You're finally starting to see that no hiding situation in the market's coming unraveled as all the sectors sell off. So pretty beautiful stuff if you're short, and willing to be able to take shorts on the intraday. So awesome stuff. And once again, it confirms more of the downside rather than a rotational market. If this was a rotational market, you'd have XLF green, SMH red. You'd have, XLP up 50 basis points, and the XLK maybe down, 75 basis points or something like that. XLU up, this 1.47%. We're not getting a rotational market. This is a sell it all market, which is exactly what happens in bears, right? And the other thing to just point out here is please, if you've been in the market for, number one, if you've been in the market for a while, I'm sure I'm not telling you anything new, but if you're fairly new, and let's just say you're 2-3 years into this, do not have short-term memory loss. Remember back to what this was like over here in April. Now, the catalyst is different this time around, but the technical structure, the underlying foundation of the market, it's the same exact thing. Again, don't have short-term memory loss. It's the same structure as what we're dealing with here. Sideways distribution, weekly downtrend, lower high, capitulation. Sideways distribution, weekly downtrend, do we get the lower high and then capitulation? I don't know, but that's certainly what we're looking for, right? And if we just even jump out further, and again, I hate that 2022 is already, sort of in the margin of needing to grab a 5-year chart, but here you go. Distribution, big lower highs, war was the catalyst, the oil shock really sent things over the edge, right? Don't have a short-term memory. The market repeats the same cycle over and over and over again. It's not to say that you'll ever nail the exact top or nail the exact low, but just don't be surprised as things develop in the way that they are actually developing. Let's take a look at the structural charts of the core sectors. Here, let me just put this back to a yearly. There we go. Energy, vertical, right? I mean, nothing to really say bearish about that. Would I be a new long up here? No, I don't really like the aspect of chasing charts like this. If anything, you wanted to get it here, maybe in here as it pulls back towards that upward sloping 20 SMA. I certainly wouldn't be a proponent for chasing it on the highs like that now. We do need to take a look at crude, of course. We've got a couple of key areas that we need to talk about. I'm honestly just going to remove the Fibonacci's because we've blown out the top end. This is the Monday morning. Let me just go to the hourly chart here. This is the Monday morning. I could even just label this Monday morning tweet, right? That's where, okay, we're going to get the 5-day ceasefire and we're going to work on this 15-point plan. Crude plummets. And then what did it do all week? It never revisited that low, just like the ES never revisited the Monday high. The SPY never revisited the Monday high, right? Here is the sort of like, oh, say something again. Just put some pressure on the market, right? There you go, March 26th. We're going to pause strikes again for an additional 5 days. And yet, what did the market do? Really? You're going to pause for 5 days? We don't care. Higher, right? Even taking out that Monday morning high. So again, it's like, forget about the politics of it all. You just need to be on the right side of the market. If crude actually, made a move lower and stuck here and was, moving lower, I'd have a completely different stance in the S&P 500. I might even be a little bit more optimistic. But the fact that crude is telling me everything I need to know here, forget about the news headlines. The underlying weakness of the market is telling you everything that you need to know. All right, let's jump from crude over. We could go over to Brent. I think that this has been a good tool to pair with. I would give a little bit of credit to Brent, just noting there is a contract roll in here. So I'm a little bit, this is adjusted, or it should be adjusted. Let's just double check. Adjust for contract changes. There we go. There it is. That's making a little bit more sense. I was going to say this doesn't quite seem. So with the contract roll, you can kind of see that we're already taking out that Monday high. And once again, this Fibonacci is totally wrong now. You get the idea. But in Brent, the more global priced oil, right, you are technically taking out that exact reference point. That's the main point I'm trying to illustrate, which once again just tells us market doesn't care about what's being said. Market just kind of cares that the underlying structure of what's happening here is bearish at its core. Let's jump from energy over to materials, and let's go back out to a daily chart here. A little bit of progress in the upward direction. Again, we'll give it some credit, but it's the lightest weight sector, still underneath 20, inverted hammers here Thursday, Friday. Take out these lows, and you're really just dealing with highs, lower highs, lower highs, lows, lower lows, equal lows, 200 and beyond is right around the corner. Utilities, just a big lower high available on the upper wick from Friday, rejecting the double top neckline. I don't really see this as being constructive, even if it does lift back into here for sideways. Defensive sector, it's telling us that the market is in risk off mode. Let's go to XLP, another defensive sector, completely obliterated top end, right? This is okay. The market's rotating. This is everything's getting sold. Plenty of room for a lower high, plenty of room for a lower high. Nothing here makes me, jump for joy about, hey, market's going to make a turn. No. Let's jump on over to the IGV. I have to say, I'm a little surprised by the IGV. I would think with the amount of volume turnover that we did through this section over here, I would think that we could see or would have seen some kind of a stronger bottom. And it's not to say that this low needs to be blown out for another 40-30% to the downside. That's, not what I don't really think that's in the cards still. But I would have thought that you could have had a more constructive attempt at some kind of a higher low in here, some kind of a 20 SMA retangling the 50. Maybe that happens in the future. Maybe this turns into a really kind of funky, inverted man ray pattern, possible, but for now, at face value, bearish. Breakaway gap on Friday, and just sitting on the equal low. Got to give the sellers some credit here, even about to take out the April low. So 77 goes, you're talking about 73, 74-ish. Very possible. And if that's the case, well, I mean, all the volume turnover was for nothing. And I suppose we're just still looking for lower in the market. And it's just another bearish data point. The Mag 7, I'm not as surprised about. Reason being is just that this is naturally a rounded top. This is sort of your big consolidation underneath. You're breaking away on a lower high. That seems a little bit more straightforward to me. The volume is not like as exaggerated as the IGV. Again, just take a look at this exaggeration. Look at how this ramps in such a big way. Look at the Mag 7, right? It didn't really do that, right? It's kind of like on par with some of the higher volume here from the April tariff. So not as concerned, or I should say, I'm not really looking for a volume turnover low in the Mag 7. I think you could continue to drift and, dare we even say come back to close this gap here at 50. That would be quite a nasty route. But given what's going on in Microsoft, Meta, Google is still the one that has some room to fall from grace. Another 10, 11% wouldn't really be that hard, I don't think, if the market's really going to start accelerating here into the low for that true capitulation. So that's that. If we zoom in and just become a little bit more realistic about what's here for like early this week, gap fill reversal on a lower high. If you do rally in here, I probably would want to have this level. What's that number going to be? Sorry for not doing all of my homework, but really just the opening print of Thursday. What's the number? Opening print 58.35. I'm just rounding down there from 36. Round numbers only. You guys know the deal. So there it is, right? 58.35. If any lower highs beneath that, the pressure's still on. Let's keep moving here. XLK, big overhead supply, finally breaking from a descending triangle here. Usually the measured move is like the top, the apex in here of the triangle. So if that's going to be the case, then I mean, you're talking about probably underneath in an overshoot of 128.25, meaning that this has more room to go. As we look at the actual structure back here, you've got kind of like this triple bottom low thing at 128.25, and then it's all about this gap. I think that is within striking distance on an official break from this range. And keep in mind, it's not just like it's this triangle, it's this entire range here. So Brigade Bolt lower highs underneath 134.50, keep the bears in control. I would reconsider if we look something like this. I would definitely have to give a little bit of the bear thesis a rest here, but for now, definitely breaking into downtrends. And if we go lower highs, again, like please, I know I'm talking like, oh my God, the market's just gonna go down in a straight line. You can set these lower highs. I'm sure I'm going to hear an earful in the comment section as in if we get a counter trend move next week and oh my God, he's so bearish for no. It's a lower high until proven otherwise, until 134.50 is actually recaptured, right? Let's go on over to the XLC, just a waterfall sell-off here. We're not getting capitulatory volume down on the lows. You could thank Google, you could thank Meta for this, losing the lawsuit on, was it Friday or Thursday after hours, one or the other. So social media addiction and, Google, Meta taking it on the chin there. And I guess YouTube is not really helping out much with that, but nonetheless, straight down, waterfall sell, no capitulation, blowing out key levels. To me, you could go counter trend lower high here. You could go counter trend lower high all the way up to here. I would still be thinking on the bear side. If we do just get continuation, capitulation into this gap, if not a little further to the 102.20s, that would also make sense to me where I would start looking for a rebound just from an oversold perspective. Let's jump on into the SMH, the one sector that still needs to crack, left head, right shoulder. You are not underneath the 200 SMA yet, but boy, oh boy, is this thing teeter-tottering on the cliff of the head and shoulders neckline. Looks brutal with the gap fill reversal on Friday. Just need a little bit more acceptance underneath 376 down to about 370 below that, and I think you kiss this goodbye at least to the 200 for a test there. Yeah, you've got some minor levels in here, but really I think the market would be looking for the 200. So that would be the pullback on SMH, and that in my estimation is what really causes the S&P 500 and the NASDAQ to actually capitulate that additional 3 to 5% give or take into the monthly high or low thesis, right? So SMH, all eyes on this, it's not a sector, but sub-industry group, if you will, into the early stages of this week. Do we blow out the neckline, or does this bounce and just keep everybody on edge? If this bounces, that's where you'll get a more frustrating market. Let's jump on over to the XLF. Financials, big leg lower on the Friday session. We are upcoming on earnings season. Midway through April is when that'll start with JP Morgan, the big banks kicking us off. But nonetheless, just a continuation to the downside here. Really ugly look, rejecting the 20, second heaviest weight sector by market cap. There's just nothing bullish about this. Let's go on over to the XLY, another one breaking away to the downside. You could thank Tesla for this. You could thank Amazon for this, breaking the bottom end of their ranges. I think Booking.com as well, BKNG, I believe. Yeah, Booking had a pretty nasty day, breaking the 3-bar play to the downside there on Friday. I can't remember. Did we put Booking as a trade idea on Thursday? Booking. Did we do it? No. I think we talked about it verbally, which is why I have the level on the screen. Nonetheless, point being, is that we do have a bearish follow through in the XLY, and generally speaking, as the third heaviest weight sector by market cap, this of course will not help the S&P 500. We've got this, and then it's all about the gap underneath us. 102 down, or I should say 103.80 down to 102 is the next target. That'll continue to just be a big headwind for the market. Even if you go counter trend, lower highs, sub 108.80, keep the pressure on. Let's jump on over to the XLI. Industrials, there we go. So a little bit of a breakdown here as well. This is a lighter weight sector. It's only about 8% these days of the S&P 500. It's kind of maintained that 8%, but it's in a downtrend, right? This was a rotational market. This is a sell everything market. It's the same concept as the XLP that we were talking about earlier. Same thing, XLV. This was going to be your constructive weekly cup and handle. If I just go back out to the weekly, right, this kind of look right up here, holding over this left side peak, would have been beautiful. Potential breakout, blue skies, kiss it goodbye, and we just have a sell everything market. Even the defensive XLV is not catching any bit of a bid, breaking down on a lower high back underneath the 200 SMA. You could look no further than a UNH, completely getting just wrecked down here on the lows. I don't know. I mean, like, there's probably decent money to be made in here, and big congrats to anybody who bought it and actually sold it. That's the key component. You had to have actually sold it. Other than that, this thing's just been kind of a train wreck ever since the major gap down over here, and when Warren Buffett started announcing that he was going to buy it. And anybody who just followed that thesis blindly without any sell rules from up here, not really working out so well, right? If you actually nailed the bottom, then congrats, you're still technically green. But anybody who bought this gap down, well underwater, I mean, just not a pretty look here on UNH anymore. Let's go, and even Eli Lilly, right? Lilly the other day breaking this overhead supply. Nasty, nasty look for the XLV. Let's finish up with real estate. Nothing good to say about this. Taking out the bottom end of the range as rates go through the roof, which of course we'll get to in our sort of spotlight risk appetite charts in just a moment. Let's go on over to the sector ratios first. What do we have here? If you're not familiar with ratio charts, check out the video tutorial in the top right-hand corner. Top right-hand corner. There we go. Firm up that voice. XLK breaking back underneath the daily 50 SMA. This was looking like an okay, not bad data point over here. Now it's just right back on the bear side. Nice rejection on the XLF underneath the 50. This is breaking to a new low over here. Local low, I should say. This actually right on the low. But nonetheless, on XLC, break there, back below the 50. This is telling us risk off, or I should just say D for defensive. Same thing over here in utilities. So no risk appetite as it relates to the sector posture and the performance. Let's jump into the A set. Really a big breakaway into the end of the week on the, this is basically cash versus tech. And again, what was so not shocking about this, but surprising was just how well this was holding up. This was like, okay, maybe tech is as good as cash right now, and then the break here is totally like, no, go to cash right now. XLU, XLK, XLU, also making a new low, rolling here on the XLY, XLP. This is apples to apples. We love that comparison. And this, of course, is the only decent looking ratio chart. Still ARK-K getting brutalized with all the Mag 7s down, and even some of those even more speculative bets from Kathy getting hit as well. The more broad-based Russell 1000 growth and value also pointing in the downward direction. No risk appetite in the A set. If we jump on over to the B set, gold, a little bit of a ratio flip here, still more sensitive to dollar and what's going on with crude and how that translates to rates. Ultimately, I should just use a percentage mark for that. So this is actually looking a little interesting, like dollar crude. Yeah, I like that. So really more about that, less about a defensive stance, but it is moving in the right direction to indicate risk off right now. Bitcoin, I think, is one of the larger tells. It was triggering a bullish Sailor shift here, completely unwound, not the actual signal, but it never actually triggered with a weekly close over the previous weekly high. So no dice on that front. The TLT ratio here also moving in the downward direction. I don't know how many ways I could say the same thing, but the risk appetite of the market is just not there, right? This is a bearish market, and the evidence isn't really turning for it. Let's go on over to dollar and interest rates. This is a massive breakout level to keep watching on the dollar. If you break out here, obviously bad for equities, stronger dollar. I would expect more downside pressure in the market. You can see interest rates continue to just absolutely ramp, and intraday, the big tool we've been using is the ZN. If the ZN continues to get sold off down here, then guess what? You're expecting rates to move higher. You're expecting the dollar to break out. And that, of course, would just be bearish for equities. So watch your bond market here. Specifically, the 10-year note is really what a majority of instruments key off of. It's that 10-year rate, right? Let's go from that over to the inverted ZT, which, of course, is the Fed equivalent, if you will. It's the 2-year note. So you could see a move higher here, a little bit of a pullback on Friday. Nothing that's going to change the odds. So speaking of odds, let's just jump into the Fed watch tool. And you can see here that we are still sitting on a completely flat curve all the way out. to the end of 2027. Recall that the more bullish market really benefits from something that looks like this, where we're cutting rates aggressively, or at least bringing rates down sub 3%, which is what the IWM would like as small caps, right? So the fact that rates are going to remain, at least the market's perception of rates, right? Obviously, this curve is going to change, but the perception of rates right now is high and tight, hold them high and level for a while. Not really great, right? That's putting a little bit of a squeeze on the market here. And the Fed, they're kind of caught between a rock and a hard place. So we'll learn more about their dilemma this upcoming week as we look to the labor report, right? JOLTS is the first major taste of that on Tuesday morning. We will be getting at 10 o'clock the JOLTS job openings and labor turnover survey at 10 o'clock. Do we have more job openings? Can people go get jobs who want them? That'll be a big tell. We'll also get some quits numbers in there, which will be important. Are quits up or down? That'll help tell us something as well. There's Powell speaking at 10:30. These are, I believe, Q&A. Yeah, Q&A is going to be expected at Harvard over in Massachusetts. So anybody over in the Cambridge area, feel free to tap in and ask him a question for the Trade Brigade. How about that? A little bit more Fed speak as we go through the week here. ADP non-farm, as always, early in the week, midweek actually, for the labor report. Core retail sales delayed, as we could see here. The next big one is this ISM manufacturing on the Wednesday session at 10 o'clock. Be watching out for that very closely. And then here, this is kind of what's a little perplexing to me. Market's still, maybe I could pull up on another news source. Let's go trading economics. Let's grab the calendar here. I'm a little surprised. Are they really going to release the labor report on Friday? The market's closed for Good Friday. So it looks like they're doing it. They even have it here on trading economics. Market will be closed. We can go to NYSE holidays. And just to double check here, let's go. This will work. There we go. I mean, I'm not making this up. Friday, markets are closed. So there you have it. Nonetheless, labor report, right? We'll see how the numbers actually come in. This is a little bit odd, right? Really critical time for the labor situation, and the market's closed to respond to it. Kind of a funky one. Futures will be open, right? ES futures will be open. They will do their thing up until about 1 p.m., I believe. You could check the CME's site if you want to double check me on that. But equities, cash market's going to be closed. So that's what we've got on the docket as it relates to economic data. Let's look forward to the earnings calendar as well. Again, there is your closure on Friday. Nothing really there. You've got nothing interesting on the earnings calendar here. Nike, don't care. Not enough to move the needle for the market as of right now. No fun ones either. There's nothing here that I'm really like, hey, that'll be fun. I mean, this is a newer IPO for me. That's kind of it. Space, I mean, that's a long lost relic of the past, so not really interested in the earnings calendar. Oh, there we go. Geez, they should move this thing up the list. Restoration Hardware, beautiful furniture. Let's see how they report and whether or not the Ritzy Rits are still spending on, $30,000 couches and whatnot. Anyways, let's get on off of the earnings calendar back on over here, and we'll jump into our supporting evidence, starting with the bond market. Are we still worried about inflation? Honestly, I'm a little impressed with the way that this ratio has tamed out. It is still pressuring that level. It could easily break out. That would be a problem. I would imagine 10-year rates continue to move higher if that is the case. Let's jump on into credit spreads. Credit spreads continue to expand, which is bearish for the market, right? This would diminish the forward returns of the S&P 500, or typically that's the correlation, right? This is a risk off sign as it relates to the market. Let's jump into HYG junk bonds moving in unison with the market. Notice this though, a little bit of a bullish divergence into the close of the week. Maybe we get our counter trend early in the week, but still we know we are seeking a lower high. So a short-term timing tool, but I would not say that this overall is bullish for the market. Let's jump on into total breadth and see what's going on here. I think that what we've learned is that we want to just cycle through it this way. So as it relates to the moving average charts, you are just right back down at the equal lows. Remember, the oversold read is at 10% on the blue line here. We're not there yet. This is components trading underneath the 50 SMA in the S&P 500. This is components under the 200 SMA in the S&P 500. New highs versus lows falling off of a cliff into the end of the week. Breadth is not improving regardless of the relative strength that you think you might see over in the Russell. Let's go this way. There we go. RSP making a new local low in here, certainly well on its way back into the lows of the November timeframe. So let's see if we can actually make it there. That would be bearish, of course. And this chart is not indicating a turn yet, so I would not be bullish on breadth, just reinforcing the same things that we've been talking about. There you go on the QQQE, big shelf of support here. If we can crack underneath roughly 96, let's say 96.20, there we go. this major low from back here. If we break that, I mean, I don't want to say kiss it goodbye in the sense that I'm guaranteeing a gap close, but I would think you're heavy towards that gap close area down there. That's the QQQ equal weight. Let's jump on into from breadth over to volatility. Here we go. VIX climbing right back up to the highs of the week. And once again, this is after a new catalyst that said, hey, we're going to put another pause for about 5 days on the ceasefire agreement. So if you're dealing with a stronger market that's actually believing the headlines, or just something that's like, oh, we don't mind the market conditions right now, you'd be here, you'd be sub 2050, not the case as of right now. Let's jump on into the VVIX. VVIX is saying the same exact thing, making a new high, even breaking that as a subtle trend line there. You're over 120. The trend of VVIX remains up. That is bearish for the market. Let's jump on into the vol futures, which we've updated the script for. Finally, deep backwardation as we go into the end of the week. That, of course, is not good as it relates to money managers putting dollars at risk. They are not going to do it if volatility is in backwardation, even the not bottom, but the back half of the curve, right? If we just go on over to this visual here, this is equally as good. I kind of like mine because it shows the different depths, but let's go into product depth. There we go. The entire curve is in the correct orientation rather than like this and then this into the back, right? It's just completely moving from upper left to lower right. The best curve is this curve, right? Which tells us there's low volatility in the present, and in the future, there might be some unknowns that we don't know about. We're not there yet. When this curve reinverts, that'll be a huge long signal. We've been pounding the table for that. It always is at the bottom end of a move. We are not there yet. If this does start to make incremental progress this week, I would be paying attention to it when and if it starts to tap something like, 25, it's not cents, but let's just say 25 basis points of inversion, basically, right? The 9 versus 30-day VIX, there we go, is technically back above zero, so kind of odd there. And then the 1-day VIX making a new local high. So bearish from that perspective. Generally speaking, the volatility complex, in my view, is certainly more constructive for the bears to be leaning into what they've got going on. What I found pretty interesting here is that the skew, nobody's reaching for 30-day puts, but if we go to the P call, this certainly is also starting to get a little bit lofty up towards that 1. So if on Monday morning, if we see this thing open up around 1, I would certainly be open-minded to a little bit of a counter trend rally happening. That's typically the way that this thing has acted recently. So P call over 1 on Monday, look for counter trend. It doesn't mean that, oh, look, markets go to all-time highs. No, it means we're looking for that lower high after a little bit of a relief rally once we've got a little bit too lopsided as it relates to too many puts in the system. Let's jump from here over into the core list of companies. Let's get the job done and finish this weekend's update video on a strong note. NVIDIA, I think this is the final straw, right? Why do I say that? There's your neckline break of the massive weekly head and shoulders, right? You could even call it monthly head and shoulders. You're finally getting more acceptance underneath the 200 SMA. You got your beautiful reject in there on the Wednesday session. Just everything about this is bearish. Plenty of room for a lower high here. Plenty of, room for a lower high here. I don't see a way out of this puzzle without some more damage to the broad market, right? This is generally not a good look. You've been sideways for over a year now, or I should say maybe not quite a full year. Coming up on a year, nobody's made any money in NVIDIA long-term investor-wise. So as and if we start to crack lower, I would have to imagine it just brings on an onslaught of profit taking. And keep in mind, like people have made boatloads of money on NVIDIA who are long from like back here, heck, even further back. Again, this 2022 analogy is killing me, but how far away that was now. But anybody who bought this and this base breakout in here, they're sitting on a pile of cash, right? So in my view, like these investors can take profit here, and nobody's going to be phased about NVIDIA moving lower. It's just like, it's the final people who are like, oh, I'm just going to continue to dollar cost average into NVIDIA up at 200 as we've seen multiple earnings reports continue to disappoint over and over and over and over again. I mean, will there be a rebound in NVIDIA at some point? Maybe, but is it going to come after you've retraced down to like 100? Perhaps you need another 100% gain just to get back here. I think you'll have new leaders at that point. And, not to say that, I guess what I'm trying to say is from a fundamental perspective, of course you're going to need semiconductors. Of course, NVIDIA makes the best semiconductors out there, but this stock was priced to perfection at the highs. So, as it relates to that, I just don't think, unless they do something groundbreaking and break the laws of physics and can perform some sort of miracle where, again, they break literally the laws of physics and they can offer compute at fractions of the cost of other compute based on their chip design. I mean, the stock's priced to perfection. I think everybody could see kind of what's going on here. And I don't know. I think new leaders will emerge. And NVIDIA might not be the sustained leader. It doesn't mean the stock's going to go to zero. That's not what I'm saying. But anyways, that's I'll stop waxing poetic here about the NVIDIA daily chart. So, and by the way, for what it's worth, I pretty much have next to nothing of NVIDIA left in the longer term investment portfolio. So that is that. Anyway, continuing along to AAPL, what's going on over here? We've got, and if NVIDIA goes higher, then I might suffer from a little bit of a missed opportunity. But for now, I think we've gotten it for what it's worth. Let's take a look at Apple at the 200 SMA. Lower highs, inverted head and shoulders, could not stick. This almost reminds me of the small caps chart, right? Kind of in here. So I think you're lower on Apple in the near term. Just failed breakout, rejecting the 20. I think you're going to break the 200 basically and continue to put the pressure on. This would help bring the XLK lower, of course. So it's just another component that will keep the pressure on the broad market overall. As we take a look over at Microsoft, this is starting to get a little bit, I would think, capitulatory. This is like straight down. You're not really seeing the volume ramp here yet, which is the next thing that I would be watching out for. But this is now a 100% retracement to the April tariff lows of last year. This is a brutal, brutal chart here. So after going nowhere, right, for about a year, finally investors get rewarded, only to round trip it and some. I think there's in my view, there's got to be something going on behind the scenes here. Maybe it's OpenAI and just the overexposure to OpenAI. They announced the other day that they had like $100 million ad run rate after the first 2 months. And I just, like, to me, the article was writing that as if it was a good thing. And I was just thinking in the back of my head, I'm like, well, they're promising like billions of dollars of revenue. 100 million annualized on ad revenue. I mean, I get that it's a pilot, but that's like, that's a drop in the bucket. Like, why? The article just seemed a little bit misplaced. Anyways, I think there's got to be something going on behind the scenes to see a continued capitulation here out of Microsoft underneath these lows. And, I would not be shocked at all to see it related to the OpenAI situation, right? We know that they've buttoned up some of their data center projects as well with Oracle. So, there's going to be a money problem. Everybody's been saying there's going to be a money problem. I think this is evident in the charts. And finally, as this started to break weekly trend way back over here, that's when you become a little bit more of a believer in that sentiment. Anyways, Microsoft continuing to look just absolutely brutal. Does it mean short it in the hole? Probably not. I'm not interested in new shorts down here. I really wasn't even interested in shorts on this low. Got to be, honest and transparent about that. So, to me, something bigger is kind of maybe brewing behind the scenes. I don't want to be conspiratorial about it, but I just wouldn't be surprised if the numbers are all off. So we'll see what the next earnings cycles bring. But April lows, we'll see if we get some kind of a bounce off the level. I wouldn't be shocked to see some sort of a reprieve, but it looks kind of like a toxic thing to touch right now. So TBD. If it does drift into a better daily, weekly uptrend, if something new can start down here, then perhaps, but pretty rough looking chart. And again, like, it's either just continuation into these April lows and then we look for a rebound, or if you do start to close the gap above, gap fill reversal for shorts up against 369.75. Let's jump on over into, and like, I'm trying to be aware as well of like how pessimistic maybe that conversation just was about Microsoft, but I don't see this as like being the next 10x play. Microsoft's going to, go to 1,000 and then not reverse split, but split and then, double again. Like, I don't see that as being the situation for Microsoft. So not really a good looking chart. And I think we'll just move along to Amazon on that note. Amazon looks better. It's not great, but it looks better. Let's go on down to a daily chart. Breaking from its little range in here, clearly underneath the 20, coming back into these lows. I would be looking for lower high opportunities, sub 206.75, and then looking for gap fill reversal. Can we get some sort of a double bottoming action over here? I think that Amazon would be a better winner as it relates to robotics and logistics, as it, in terms of implementing the AI stack, so to speak. So Microsoft, as it relates to software, I mean, you've got the macro hard thesis from Elon kind of coming for its throat. I mean, obviously, Microsoft's got better, maybe hopefully more durable enterprise contracts there. But Amazon, I think, has a little bit more of, dare I put my investor hat on and say the term moat, as it relates to that. So, and of course, like, let's not forget about Azure, right? Microsoft makes 90, maybe not 90%, but a majority of revenue comes from Azure. They're not the licensing contract. So anyways, point of the exercise is that I do believe, and for Amazon, it's AWS. I do believe that Microsoft's probably not going to zero. Amazon's probably not going to zero, but I do think that Amazon has a little bit more of an edge as it relates to this AI implementation bit. So we'll see as it relates to that. Nonetheless, watching for this gap close down below. If we do move lower than that, all of these levels are pretty dicey. Let's just look further left. This is just kind of a sloppy range. And then you have this gap close from the April situation almost coming up on a year ago now. So that is that. Not a great looking chart under the 200, the 50, the 20. kind of just, rambling on about how bearish things look out there. Let's keep moving along to Google. Google is going through its own version of NVIDIA's head and shoulders, but this one has not really had a substantial sideways period yet or a fall from grace. This has been more so sideways recently. I'd say up here it was still looking like a relative strength leader, and more recently in this section of price action, really February and onward post earnings, it's looked a little bit more like, okay, you're not immune either. Google losing the YouTube side of the court case there into the end of last week, certainly putting the pressure on in the downward direction. Any lower highs sub 296 will keep the bearish head and shoulders in play, ultimately looking for the 200 SMA on the downside. If we do continue right out of the gates, I would start looking for a counter trend off of that, right? And also, by the way, like this, I overshot that arrow by a mile. This prior balance range low could be where the lower high is set at 276.25. All right, so what are the outcomes here on Google? Stretch and rubber band. Number one is here, lower high and continuation. Stretch back like this. Awesome. Lower high is still set. Something along those lines are the name of the game for Google. It doesn't really look great when you're zoomed out like this. So if the market does make a turn, Google would be one of the names that I'd look to as a stronger leader because of its position relative to the daily 200. But for now, definitely in a reversal, and definitely, no doubt about it, you're in a downtrend. There's no arguing with that. So we'll treat it that way until proven otherwise. Let's go on over to Broadcom, another one that's starting to fail more meaningfully underneath its 200 SMA. Just a little frustrated on Broadcom with, it took some 0 DTEs on Friday. It's punished for that, but I don't want to clear the drawing set. I just want to remove that drawing. It's kind of what reminded me of it. Punished on the 0 DTEs, but directionally correct here. 300 puts only came into the money into the very final wee hours of the day. Nonetheless, breaking the overhead supply, and as of right now, would be looking for a continuation into these lows here at 285.25. That seems fairly straightforward to me, and it is a double of this range right around in there. That's it. Looking for downside, either lower highs sub 309, in continuation, or straight up continuation to put the pressure on the overhead supply, right? If we go look below and fail, I'm hard pressed to be long on that situation. I would rather just look for another lower high short up against the moving average stack. Does the 20 start to barrel down on price? Does the 50 start to barrel down on price? Can we get some kind of a combined reaction off of that and then continue in the downward direction? Let's go on over to the metaverse. Another one, big loser based on the lawsuit there, completely wiping out this gap in one session. No red to green move on Friday morning. The rubber band is completely stretched out of Meta here. This is down from this lower high, approximately, let's call it 18%, with how much of that coming from 2 days? 10% of that over the span of 2 days, Thursday's gap and go. So really brutal price action. I would be starting to keep an open mind to the red to green move, and that is for a counter trend setup only. This is not like, oh my God, we're doing this. This is like, okay, here's maybe a long position to go counter trend, stop underneath the low, take a piece of it, and then reevaluate. Lower high, certainly room. Lower high that looks like this. Brutal looking chart. I'd say that this is like equally as bad to something like a Microsoft, where you've just gone nowhere for a while now. Investors probably getting a little bit tired. The metaverse didn't really work out, right? The whole 9 yards, just not really looking great. Still killer ad platform and making dollars hand over fist on that front, but for now, stock isn't really rewarding the next look other than the dollars and the ad platform. So that is the metaverse. Let's go on over to Tesla. Another one that's kind of not immune to the selling pressure. I'd say it's not as bad over here on Tesla, but no doubt. I mean, you're still in a downtrend. Highs, lower highs, lower highs, lower highs, lower highs, lower highs, lower highs. Right? We could do this all day long, and there are your equal lows, blowing that out into the end of last week. Lower high off the moving average stack, and just perfectly in the downward direction again. So beautiful setup here, and just looking for continued downside through some of this thin structure. Gap close to the downside here at 340, 375, 339 area becomes the target. Those are the next downside levels. This is a pretty substantial weekly breakout point over here. So if this does start to firm up and just go sideways for a little bit, I would keep an open mind to Tesla. Although underneath the 200 SMA, I would keep an open mind to Tesla. Maybe if we can build out the right side a little bit, maybe this starts to look like left, extended head and right. Maybe if it can build out the right side, it's a low, but kind of hard pressed in the current market environment as of right now. For now, I would just maintain a little bit more of a bearish stance there. It's going over to JP Morgan. Earnings around the corner, but just a lower high here, back below the 20, and getting brutalized on Friday, just like the XLF as a sector as a whole. So nothing really constructive to say about this one. Overhead supply still exists. Bearish, bearish, bearish. Nothing, no update to the thesis here. Still looking for downside. It's going over to Palantir. This one's a little bit more confusing, dare I use the term. Rounded bottom, trying to go bull flag up here, and just completely look above and fail underneath the 200. So it just goes to show, once you lose that 200, it's a pretty tough turn to make a more constructive look without a solid, you want more than just like a 2-week base here. You probably want like a 2-month, 3-month base to form like this. Maybe this is the high or low, and then maybe in the future it's this, TBD ultimately. But for now, just really weak like the rest of the broad market, even failing on Friday underneath this inflection point here on 145. So I'd be thinking about lower highs sub 150, keeping the pressure on, something that looks like that. It's just a double top neckline retest, right? If that's your double top, here's your neckline lower high, looking for movement in the downward direction. Let's jump on over to AMD. What did have some interesting relative strength on Wednesday, completely unwound on Thursday. No gap fill reversal, overshoot, just a doji hammer inside of the chop and slop range. So being that we are just inside of literally the midpoint of the overall balance, I'll be patient. If we're over 204.75, maybe thin structure retracement, but I'm not overly bullish there. If we do start doing this, I'm still really interested in the OpenAI gap down below, noting all of the issues we talked about over on Microsoft with OpenAI in particular. So if they can't make good on their contracts, then, something that looks like this and beyond, kiss that revenue goodbye for AMD. Let's go on over to Robinhood and see what's going on here. Finally breaking from this little bear flag consolidation. Bitcoin did start to break lower as well, so you're not having that bullish divergence from the coin anymore. I don't love new shorts down here still. You could call that insane. I do get it that it's breaking down from the bear flag, totally on board. In the short term, if you want to short it now that we're underneath the range, that's fine. But as we were going sideways, I was a little less compelled about that. Let's get into the weekly chart just to continue looking left, right? That's why I don't like the weekly new shorts, right? So if anything, I would like to see Robinhood extend some of the losses a little bit, and then maybe, I still haven't seen IV rank really get cranked here yet. Let's go to sets. Let's just grab this, add selected. There we go. Just want to look at, and we don't want a weekly chart. We want the daily chart, please. And let's just make sure that this is set to a 60-day. Good. 60-day is about 3 months, right? I want IV rank up and over 65. I'd start selling puts maybe down around 50. If we can get that this week, TBD. But that's the situation I'm looking for on Robinhood. All right, that's the core list of companies. Let me reset this just to bring the steady set back to normal, and then let's get into our additional ideas. We won't go through all the leaders, but MU and SanDisk, which are leaders, are in the trade ideas section this week. So here you have it, bearish 3-bar play in MU. If you break that, think about the overhead supply, longs late to the party, either longs late to the party or just distribution up here at the highs. Failed all-time high breakout. It's already ran for, let's not forget what MU, SanDisk, and the whole memory complex has done. Let's just take the most extreme read, right, from the dead low up to the high. That's 675%. So to really think that, it's impossible for a little bit of a pullback here, right? That pullback is what, 26% into this prior high for this, third weekly leg, like 1, 2, 3. That's not unreasonable. So is there some sort of a short here on MU as it goes backside in the near future? Maybe. Bearish 3-bar play here. You are straight down from the highs, so it wouldn't be unreasonable for like a 3-day bounce, lower high, and then you get this. And then question, what did we say the one sector is that still needs to break for the market before we can really get that 3 to 5% move? Semiconductors, right? So you go counter trend here, you set the lower high against the moving average stack, 20 crosses the 50, break the equal lows. Now you're talking about your capitulation situation for the S&P 500. Just like MU is SNDK, you can see it's a little bit better. It's not threatening those lows, but you do have in the upper wick a rejection of the 20 SMA, failed all-time high breakout. Emphasis on the wrong syllable there. But underneath these lows could be interesting into the low end of the flag. I think MU looks a little bit more actionable, even if it takes a lower high happening first. So those two are from the leaders list. DELL is honestly from the leaders list, and DELL is going to hit the radar here because of this action right here. If DELL can pull back into 167.25 and pick it up, that could get interesting. Right? If we need some kind, let's say the broad market goes for a counter trend bounce and you're looking for longs this week, DELL would be a place to look. Another place to look, which honestly was, you're going to get, I guess this makes 4 or 5 if you want to count SanDisk. I didn't really count SanDisk as a trade idea, but it's in that memory complex. Let's go to Marvel. Let's go to MRVL. And this kind of doing well on the earnings gap and go, nice sideways consolidation, retesting the top end of this breakout point. This just came to memory based on what DELL, no pun intended, based on what DELL chart looked like. And the alert went off on Friday as we retested that. So actually, Marvel could go on the early week watch list if we get a counter trend out of the broad market for a potential long off of 93.75. And then finally, this one was the final of the 3 that I originally had. A name that nobody, I don't think, is remembering, but had really odd relative strength on Friday. They have a new marketing director, a new class instructor director, Peloton. Look at this volume and look at this big green bar on Friday when the market's breaking on a gap and go to the downside. Potential for a short squeeze was what I was reading about. I didn't really see much in the way other than that. I didn't really, maybe like an upgrade perhaps, but it was just relative strength on Friday. Now, please, before anybody's like, dude, that's so stupid, why are you going to long Peloton on a downtrend? Like, I get it. You're underneath the 200, you're underneath the 50. Price just hardly reclaimed the 20. What I would say is, like, if this thing can be constructive and set up a base down here, maybe there's some kind of a long, just as like a trade, a scalp only. The price point is brutal. It's probably not something that you're going to do with options. You're just going to trade it via shares, and that is fine. I mean, look at that. A 5-cent increment is making that big of a difference. That's the opening print of Friday, so it's good enough. And then this can come in at, let's hopefully say 85, maybe is good enough. Yeah, there we go. 485 with this gap to close overhead from earnings up into about, let's say 560. Can we get away with that, or is that too much? We can get away with that. So there's your gap above. Again, the point is this is absolutely in a downtrend. I get it. The chart looks absolutely brutal. Here's the weekly chart going nowhere, not really trending. Brutal. Relative strength on Friday is what I'm keying into. If you could consolidate, build out the right side, and maybe there's some kind of a gap trade here in the near-term future, that wouldn't be the worst thing in the world. What is that? 17%? I mean, I wouldn't shake a stick at 17%, right? So if we can get a gap close, maybe there's something to do here. The main reason, not only is the green relative strength there, look at the possibility of the green bar on the volume, right? One thing that we could do is let's maybe go on over to, how do I want to do this? We could go FinViz, and we could jump into, where is this? PTON. What's the short interest is what I care about. Short float, about 16%. It's not hugely elevated, but it's up there. So maybe there's a bit of a short squeeze that could start to unwind as well as it relates to that. That is Peloton. All right, that's what I've got for you in today's episode and installation of the, not pre-market prep, but rather the weekly watch list. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. As always, we'll be live 8 a.m. Eastern time here on the channel for the pre-market prep on Monday. Kicking your day off with a technical breakdown of the broad market, ES futures, NQ, S&P, QQQ, the whole 9 yards. We will get the job done as we typically do. Hope to see you there. Have a great weekend, and as always, I will see you in the next one.